Or what did you do over the last week or last week and a half? Do you have any vacation plans? I want to get that dialogue started without business. That goes on for 5 or 6 or 8 minutes. I might tell them a story. Everybody's relaxed. And then when I do 10 minutes into it, in my example, I said, let me lay out the agenda today for you. I said, what I've done over the last 2 meetings is I've collected a lot of data from you, a lot of information, both in written form and verbally. We've already done the risk analysis, the fee analysis. We did that through Y charts and nitrogen. When I ran the risk tachometer for you at the end of meeting number 1, you both indicated that you wanted a risk factor less than 10%, ideally around 5% if we could get it there, based on historical benchmarks. You also told me that you needed enough income to maintain your budget. You're concerned about inflation and long-term care. So I took all those considerations that you have given to me. You wanted to make sure also that you didn't make a financial mistake at this point in your life since you just retired. And you wanted also, ideally, if you could use your assets for income for the rest of your life and enjoy the things that you planned for when you weren't retired, you also want to leave some money to the kids and the grandkids. Is that a summary of what you've told me so far and what your objectives are?
There's one thing I forgot. She got long-term care insurance. She's going to pay $100,000 over 5 years. So she paid $20,000 this year, and that $20,000 is included into that $95,000.
Perfect.
Budget.
That's perfect. Okay. But she still was concerned about long-term care because that's why she got the long-term care policy, right? So ideally, what we want to do today, Mr. and Mrs. Smith, is those objectives you've identified and articulated to me. I put together a draft plan to solve all those. Now, when I say draft plan, that means it's draft. We can change anything you want today. You allowed me, after meeting number 2, I asked you, would you give me the ability and the latitude to draft this plan up? And then today, you're going to look at all the material and all the numbers, and you're going to tell me if you want to make any changes. You want less money here or more money there? That's what today's for. So any questions that you have before I get started? And did I miss any objectives that I've stated to you that you still have that I haven't articulated? No, Jim, you've articulated everything perfectly. That's exactly what we've said to you so far. We're so anxious to see what you put together for us. And that they say that 95% of the time, just like that. So now I'm into it for 15 minutes, okay? It's a 2-hour meeting. For the next hour and 45 minutes, I'm presenting the draft plan. So I'm going through the plan page by page by page, stopping in between each page to make sure they understand what I'm saying. Go back to the narrative that's been written if they don't understand it, so they can take it home and read it next time. And I also tell them on the front end of that meeting, I said, by the way, I've not printed anything out for this meeting. And the reason for that is you may make some changes to the plan today, and there's a lot of stuff we put together, and you'll see that next time. But when you come in the 4th meeting, which is next time, I'm going to make any changes that you want to make today that we talk about. I'm going to print everything out I've done so far for you from the beginning, from meeting 1, 2, and 3, everything will be printed. In our next meeting, which will be in meeting number 4 together, I'm going to put the black binder in front of you, which is all the printed material, and we're going to go through the same thing on the next meeting that we're going to go through today. You're going to have to see my plan several times for you to really comprehend it. So today, what I want you to do is I don't want you to get hung up on the details today. What I want you to do is get the concept of what I've laid out for you in the draft plan, because there's a lot of details. We'll get into the details later, but I don't want you to be uncomfortable because there's a lot of numbers here. I want you to see it and express any concerns you have, any comments, and by the end of this meeting, you're going to become very educated, and I think you're really going to like what I've done so far. So that's how I start meeting number 3.
So she gets this draft plan on paper today or on screen only?
Nope. I do not give them the draft plan until the 4th meeting.
Screen. Okay.
Nope.
Thank you.
Because if you give it to them today, they're going to take it home, and there's a good chance they're not coming back. Because they're going to take it home, read it, and they may source you. And you haven't developed the relationship yet. You need to continue this process to meeting number 5 to really confirm that relationship and give her the feeling that she can trust you can trust your firm, she's moving a lot of money over to you, and that just takes a lot of confidence on her part, and that confidence comes from a series of meetings, right? continue to see her and see her. And she's going to have to see this plan at least twice or three times for them to really digest the data. Okay?
Verilyn just wanted to know, do you show them the numbers to review in a PowerPoint?
Of course, we have the whole plan like I did last time, right? So in the whole plan, let me bring it up here and let me just make sure you guys understand here. See where I have it here, I think. Continue asking questions. I'm gonna have to find that plan where I put it.
Sure.
Okay, here it is. So I'm going to share my screen with you in 2 seconds. By the way, I'm sorry, folks. I'm looking at one screen. I'm in my home in Lake Tahoe, and I'm looking at one screen and I'm talking to another one. So I apologize if this is a little disconcerting when I look at when you guys are looking, or when I'm looking at you here. So let me share my screen here, and you tell me, Dina, if you can see my screen.
Yep. Mm-hmm.
Okay, this is the power. You can see the colored, right?
Mm-hmm. Yep.
Okay. Is it big enough for you?
Yeah, I can see it pretty well.
Okay, let me look a little bigger, just make sure.
Okay.
Is that better?
Yeah, that's great.
Okay. So remember, I went through this last time. We would not do a third meeting without a plan, right? It's futile for us. Unless we go through our process, our chance of success is going to drop dramatically. So meeting number 3 and meeting number 4 are identical. There's no difference. The only difference with meeting number 4 is now printed out in a binder. You're going to go through the same data. So on meeting number 3 and 4, it doesn't really matter. I'm going to introduce them to the plan. So meeting number 3, if they're in your case, I'm going to say what I've done for you is I built a plan for you. It's going to include your budget, your risk, your current fit risk, and the new risk profile that I put together for you. It's going to include your current fees and the new fees based on if you move to my firm. I laid out an income plan by month and year for the next 30 years by income source. Is the income guaranteed? Is it not guaranteed? Will the income go up or down by income source? We've done full tax returns in the background. I'm going to give you an analysis on just a cover page so that I can show you how much gross income, how much is taxable. I took your standard deductions that you get from the federal and state governments. I'm going to show you what your federal tax is going to be and your state tax is going to be. I'm going to show you what your after-tax income is going to be. And I'm going to show you how that after-tax income is going to relate back to your budget. On your budget, I've increased your budget by 2% every year for the next 30 years based on inflation. And then I'm going to show you how much is going to be left over at any given year after you're extracting income out of the assets, right? You're taking income off those assets. What's going to be left in the portfolio if either you or your husband passes away, or if you both pass away? Is there going to be any money left for the legacy? So that's what we're going to talk about today. Any questions? And they say no questions, okay? Okay. So then I said, here's a table of contents. When you get this plan next time in writing, because again, I'm not giving it to him this time, I want you to go through the table of contents. And if you want to go to a specific page number, you go right to the page number. For example, if you want to go to the fee section and you want to see what your current fees are, which I'm going to explain to you today, and what with the with plan fees are going to be, my plan, you're going to be able to go right to that page, right? So we put this together. I put together a disclosure for you. What is this document? The summary of retirement income sources and factors, using an annuity as part of your retirement plan, no guarantees for investment returns. These are all disclosures that I put together. This is information that I think is important for you to understand based on how I, as a fiduciary, build out a plan for a client. So you can read this thoroughly next time once you get this home. But for the time being, I'm just going to kind of go through here real quickly. And I'm going to jump down here. Let's start with your budget. As I mentioned to you before, one of the most important documents in the entire planning process is your budget. We have to make sure that you have enough after-tax income every year for the rest of your life, and we can see that based on the plan. Now, in your example, I used a 2% inflation rate increase every year in your budget. But if you want me to use 2.5 or 3 or 3.5 or 4, I can do whatever you want to. But the draft plan uses a 2% increase. So what I show them here is I go right to the budget page here, and I go through the budget with them again. Now, this is the second time I'm going through the budget with them, because the meeting number 2, I've already had the budget. I went through it. And I said, do you have any things here that, by the way, this is a single person, one of the lowest budgets I've ever seen. But she was very frugal, right? So at the bottom here, I said, you have, if you go down here for standard trips, you have no travel in here at all. And I said, do you want to travel? I said, yes. I said, okay. I said, well, if you want to travel, do you want to spend $10,000 a year, $15,000, $20,000? She said, well, I can't spend that much. I said, yeah, you can. And you're going to see in a minute, I got you significant excess cash flow, because one of the first things you told me when we met on meeting number 1 is that you wanted to travel the world, but you were afraid to, because you're afraid you didn't have enough money, or you run out of money, or the stock market would crash and you couldn't do what you wanted to do. So I've taken that into consideration. Even though your budget only shows $2,400 and there's basically no travel, I got you significant excess cash flow, net after tax, so that you can travel. I'm going to show that to you in a minute. So I go through that. So I'm going through, and by the way, when I bring up a spreadsheet here, whatever the spreadsheet may be, I explain the spreadsheet, very clear, simple to see, understand. Then I tell her, in this example, her name was Hillary. I said, Hillary, next time when you take this home, when you look at this, if you forget how I described this budget page, I want you then to read the narrative that we put together for you. And this is nothing more than what I've just told you. So if you get home and you don't understand the budget page, well, read my narrative. It's exactly what I just told you, but really definitive, to make sure you understand why the budget is so important and the considerations I'm making when I'm doing the plan, trying to get you excess cash flow on an after-tax basis above your budget every year for the next 30 years. This will explain that like I explained it to you in the past. So getting back to the question earlier, again, each one of these sections you're going to go over. So when I get to the risk section, remember, I go to the spreadsheet first. Go down here. Here's the spreadsheet. And I explain the spreadsheet to them like I did last time in the meeting, right? Left-hand side are all their accounts. And at the bottom here, the risk factor that was provided by Nitrogen report, third-party data, research information, not our stuff. They can look at the data, and what it shows them here at the bottom, if we have another 2008 financial crisis or another tech bubble where the market went down 50% and gave both those instances, on the Vanguard retirement plan, they're going to lose about 33.5% of the money. On the Vanguard Roth plan, 56.1%. On the Vanguard Trust account, 55.8%. On the Vanguard SEP, 27%, and no money on the cash and money market. Again, that is provided by Nitrogen, a research company, based on their sophisticated data and analyses, is what you must be prepared to lose if we have a market drawdown of 50% in the future. Now, if we have a drawdown of only 30%, well, cut that down by about 40%. But again, that risk factor is significantly higher than what you told me you wanted it to be. It scared you when you saw that, Mr. and Mrs. Smith, and substantially greater than what I believe a plan can work. Because if you go through retirement with a plan like this right here, you stop right here, and you have a 39.6% risk factor, call it 40%, and you're drawing income off your assets at the same time the market goes down 40%, I will assure you it will almost be impossible for you to recover. And I will assure you, you will entertain a substantial amount of stress during that period. And more than likely, you'll start making bad decisions, because when you were 30 or 40 and the market went down, two things. You had less money, and number two, you were younger. You could ride it out and hopefully get back. But now you're 64 and you're retired, and you're going to draw income off these assets every month and every year for as long as you live. At the same time the market goes down, it will be catastrophic if that event occurs. And I'm going to show you a little bit later in one of the spreadsheets I put together to give you an example of that, how that would work. And what will happen is you'll probably make a real bad decision. The market will go down, you'll get scared, you call your broker, and they'll say, stay in it. The market will go down another 5%, you call your broker, and they say, stay in it. The market will come back. The market's down another 10%, and you call your broker, and now you're really nervous, just stay in it. The market will come back one day. Now, all of a sudden, you're retired, you just lost 30% of your money, the market could go down another 20 or 30%. You say call your broker and you probably get out at the wrong time. You go to cash, you already lost 30%, then you'll never get back in, and then your retirement plan won't work. So this type of plan right here that you have, I personally feel that it will, I'm not saying it can't work. Anything can work, but the probability of it working is very, very remote. So I spend time on that, and they're nodding their heads, oh yes, we can't have that, because you've got to get them engaged in this whole process. And I said, do you have any thoughts on that? The way I articulated that is really, I've just taken what you've told me over the last 2 meetings. What do you think? You feel comfortable having that risk factor? Oh, no, we can't have that risk factor, right? So let me skip over here. Let me get out here for just a second. I want to go back to what I want to answer that one question earlier, Dina, but let me go back. Can you see this PowerPoint that's brought up here?
Yeah.
I mean, this happens to be AIG. We use a company called Annuity Genius. They're a third-party company, and what they do is they do a feed every night into all the major insurance carriers offering fixed annuities. So each morning when I walk in, we have a license to use the software. I can enter my parameters, and I can find the highest income annuity for a client 62 and 64, the highest income annuity for a client that's single, 62, but wants to turn on the income in 3 years. I can enter the data, and it searches all the companies that True Choice provides us, right? We have a list of them. So we go with that. We don't make a decision based on how much we're going to make, right? Or an emotional decision. We're using the technology to determine what is the best fixed annuity for the clients I have in front of me at that given time. And we don't deviate from it. Now, I actually show the client the Annuity Genius printout. It ranks them. I might do a printout, might have 13 different carriers based on the same parameters, what their income is going to be, 1 year, 3 year, 5 year, whatever I'm looking for. So AIG, for example, has been coming up for the last 6 or 7 months, number one. They have the highest distribution rate of all the companies that we're searching. They meet our qualifications of A-rated in business over 100 years. So what I do when I get to the meeting number 3, at the back end of that meeting, I'm going to show them the illustration. So last time I did meeting number 3, and again, remember, meeting number 3 is the same as meeting number 4. There's no difference except meeting number 4 has the binder, it's in front of them, and they're looking at the pages. On meeting number 4, I have this screen up on my 100-inch screen, TV screen in the background. So if I have to get up and walk to the screen and point something out, I will. But 90% of meeting number 4 is the binders in front of them, laid open, page by page. I'm going through it again, just like I did at meeting number 3 when it was on the screen. No difference. On meeting number 3, again, I'm going to go through the annuity illustration at the very back end of that meeting. So, for example, this is AIG with this client here with a single woman, and I tell the client, every financial instrument in the world has advantages and disadvantages. It is no different than the annuity. For example, if I put money in the bank for you, the advantage is as safe as secure. Up to $250,000, you're insured by FDIC insurance, right? But at the same time, you can't expect a high rate of return long term. Yeah, the rates are good now because interest rates are high, but it's going to go down. And it's liquid, so the bank money is going to behave a very certain way. If I put money in our third bucket, which we call the red bucket, which is money in the stock market, it has advantages and disadvantages. The advantages are you have growth potential. The advantages are that you might be able to make a lot of money with it, and it's liquid. The disadvantages is you could lose a lot of money or all your money theoretically if you're not positioned correctly. And of course, the middle bucket is the annuity, which I'm going to show you the illustration right now. That's called our green bucket. I'm proposing that you consider this annuity to make your income plan work, which I'll show you in a few seconds. And the annuity has its advantages and disadvantages, right? It behaves differently. If I put money in the annuity, I know contractually that I can never lose a penny if the market goes down. I can never lose a penny if interest rates go up or down. My income is going to be guaranteed for my joint life if I'm married or my single life, no matter how long I live. if I ever run out of money in the annuity contract, the insurance company is still contractually obligated to pay me for the rest of my life, no matter how long I live. When I die, they don't keep your money. If there's money left in the contract, it goes to your beneficiaries. The disadvantage of the annuity is that, again, you have a fee just like you have assets under management, but it's a disadvantage. You have a surrender period, which I'll talk about in a few minutes. And you're not going to get anywhere near the growth potential, theoretically, that you could get in a managed portfolio, but you're not going to take any risk, right? You have no risk. So the three buckets that we propose for you, Mr. and Mrs. Smith, cash, annuity, money to market, they all have advantages. They all have disadvantages. They all behave differently, but that's why we've structured it this way. So let me show you the disadvantages first of the annuity. So right here to this page. And what I do is actually circle it for them. I said, first of all, you have a fee. And if you look up here where it says second paragraph right there, and now let me highlight it, but the second paragraph has a fee of 1.1%. You're going to pay that fee directly to AIG, your insurance carrier, for the guarantees. The guarantee, if the market goes down, you cannot lose money. The guarantee, if interest rates go up or down, your principal not affected. The guarantee is that once we start income, the income is guaranteed for your life. And the guarantee is that you do participate in some return potential in the index you're going to be linked to, which I'll explain in a minute. And when you die, the guarantee that they won't keep whatever money's left is going to go to your children. So that's what you're paying the fee for. I do not charge a management fee for that. I don't get any of that 1.1%. Now, when you put money under management, we do get a fee, whether you make money or not, which I'll talk about in a few minutes. But on the annuity, the insurance carrier pays us directly because they don't have an office here. They don't have employees. They pay us two ways. They pay us a commission up front, which you're going to see next time at meeting number 4. You're going to see it. I'm going to show you exactly what it is. No, I'm sorry. It's at meeting number 3. I'm showing it too. You're going to see the fee in a minute, what we're getting in commission. And then my partner and I elect to take a trail. Typically, it's about 0.5% from some of the carriers. And that trail allows us to have cash flow coming in so that I can meet with you and maintain the relationship and make changes to the plan and do review meetings with you. So you're going to see exactly how we get paid from the insurance carrier later on. But right now, I want to let you know that that 1.1% doesn't come to me. It goes directly to the insurance carrier for those guarantees I just explained to you. The second negative is you have a surrender period. If you look in the second line of the second paragraph, 10.987654.321. What that means is you're giving your money to the insurance carrier. The insurance carrier in return is giving you a lot of guarantees. As such, they can't take that money and stick it in the stock market or go out in a bunch of commodities or other risky investments. The vast majority of the money goes into a bond portfolio, most of them investment grade, and they're going to manage that bond portfolio and protect you from any risk in that bond portfolio. And they know that as long as you don't break your contract or you don't take out more than 10% in the first 10 years each year or more than your withdrawals, that they're going to have dividends or interest coming off those bonds and everything works for them. But if you take out more than 10% in those first 10 years, each year or every year, then all of a sudden, they're going to have to sell some of those bonds off and they're going to charge you a penalty. They're going to disincent you from doing that. And first of all, you never want to do this if you're even thinking about doing that. We don't do the annuity. So you do over here in this third line of the second paragraph, which says 10% free withdrawal amount. What they're saying here is that if you get into a situation where you do need to draw money out of the annuity within those 10-year period, you can draw 10% each year, penalty free. 10%, 10%, 10%, 10%, no penalty. Now, if you do that, your income is going to go down by that same proportion because you're taking money away from the insurance carrier, right? They don't have your money. So you don't want to do that, but it's in there in case you need that. In theory, you can liquidate it over 10 years with no penalty, right? 10, 10, 10, 10, 10, right? 100%. I said, but you're not going to do that. We didn't put all your money here. We have plenty of liquidity in bucket 1 and bucket 3, which is cash, in the market. That's all liquid. You'll use that before you mess with your annuity, because your annuity is your pension income stream for life. So in closing, there's three negatives. You have a fee, you have a surrender period. If you take out more than 10%, you can have a penalty. And they all tell me the same thing when I explain it this way. Well, that's okay. We're not doing it for that reason, right? They never have a problem with it. So those are the disadvantages. Now let me go through the advantages now. So I go down here, and I go right to this page here. So I say, you have advantages and disadvantages. You see on the left-hand side at the top, that banner is light blue, and on the right-hand side is dark blue. There's two banners. I'm going to explain the left-hand banner for you first. So you're going to put in $613,367. That's your premium investment into the account. And if you look at the right,
Can you make that any bigger?
yes, I can. Give me 2 seconds. I think I can. Let me find my.
Oh, there we go.
Let me hold on 2 seconds.
Okay,
better?
perfect. Yes, thanks.
So if you look here on the right-hand side, do you see where it says MLSB 2-year P2P with the spread, DFA US 2-year P2P par with the spread? And they say yes. And I pointed it to them, right? I said, what has happened here is the insurance carrier has defined, and they'll give us a list of different, in this example, investment strategies. ML represents Merrill Lynch. DFA is like a Vanguard. They're a huge company. So what these two companies have done is they've created an index, and the index is comprised of stocks and bonds, maybe some commodities and cash. And these indexes just run, just like the S&P 500 is an index, it just runs, or the NASDAQ is an index, it just runs. If you see the second to the last column where it says participation rate, it says 100% and 145%. And then the last column, it says rate, 2.1% and 0.5%. So what that means is, I selected a 2-year point-to-point strategy with you because of the economic environment we're in today, with all the politics and what's happening with the tariffs. We can go to a 1-year strategy, but I'm electing a 2-year strategy to get through this period of time. Now, if you want to go to a 1-year strategy, we can, but they'll give you less money, and I just believe right now it's better with the 2-year strategy. So it's a 2-year strategy. It's called point-to-point. Let's assume you signed the contract today, or your contract was issued today. That's day one of that's your anniversary. Over the next 2 years, these indexes are going to just operate. They're going to go up and down, right? Stocks and bonds, just an index. 2 years from your contract date on that anniversary, that strategy period terminates, is over. Merrill Lynch, let's just assume both those indexes are up 10% in my example. Well, Merrill Lynch, you would get 100% of the 10, you'd make 10%, minus a rate called a margin or a spread of 2.1% for each one of those 2 years. So 2 times 2.1% is 4.2. So if you're up 10, minus 4.2, the difference, you made 5.8% rate of return. That make sense? Yeah. And the reason they're doing that is because you have no risk, because if those indexes are negative for any reason, you cannot lose a penny of your principal. So Merrill Lynch is saying, hey, I'm going to try to get your rate of return, but you folks have no risk. There's a spread cost there. There's a cost for doing this called, buying options and derivatives, which I'll get into later. Now, DFA says, hey, I'll tell you what we'll do. I'll give you 145% of the gain with only a 0.5% spread rate, which means, let's say it's up 10 times 145, you're up 14.5%, minus 2 times the 0.5%, you're down 1, you're up 13.5%. And you might say, well, why don't we do all with DFA? Well, we can. But Merrill Lynch, is going to be more aggressive, even though they have a higher spread rate and going to give you less money, they might get a better rate of return. We don't know. So it's like having gone to the racetrack. I got 2 horses on the racetrack for you. We can go to 3 horses or 4 or 1. It's up to you, but I want you to get the concept today. Did that make sense? Yes, it makes sense. I said, okay, now let's go over here. On the left-hand side where it says $613,000, that's your premium investment. Go to the far left, year, your age, there's Merrill Lynch, there's DFA. In this illustration, it's assuming that Merrill Lynch and DFA are flat or negative every year. Just assuming that, worst case scenario, right? The fifth column where it says credited interest rate, that's you. If the market is, or if those indexes are down, the worst thing that can happen for you is you have a 0% rate of return because you can't lose money. So it has all zeros. Interest earned, well, you didn't make any money because in that example, if they were negative or flat, you didn't make any money. Contract anniversary value, 613,357. That's what you put on day one. See, the next year it goes to 606, then 598, then 589. You ask yourself, well, why is it going down? Because you're paying a fee of 1.1% each year, and you have no gain from Merrill Lynch or DFA. Just like you pay a fee in anything else, if you have no gain, it's going to go down. Now look on the dark blue ribbon at the top. Income base, 613 in dark blue, then it goes to 665, 717, 769. Now I'm turning your income on in the fourth year. That's why I stopped there. What's happening is with this particular carrier, they're giving you an 8.5% called a roll-up rate every year you defer. And your plan, I have you deferring for 3 years and starting the income in the fourth year. So you can see here in green, if you want to start income right now, it'd be $42,015. If we wait 1 year, it's 8.5% greater, it'll be $46,584. If we wait another year, 51,000, and I'm waiting to the fourth year, it's going to be 56,193. That's when I'm going to activate or turn on your income. The income credit is showing you the 8%, 52,135 every year for 3 years. That's the roll-up rate. So it's very similar to Social Security. If you take it at 62, you get a certain amount. 63, 64, it goes up 8% per year. Very similar concept, 8.5% per year. Now this is not for, that's not for lump sum distribution, income calculator. Your real money is on the left-hand side. This is just an income calculator. So when you turn 64, when I turn on your income there, or 63, I know contractually AIG is obligated to pay you $56,193,000 every single year for as long as you live. Now, they're not going to just give it to you, however, because they like you and you're pretty. That's not what they're doing. That $56,000 is coming out of your portfolio value or your contract value every year, just like it come out of the bank account or just like it comes out of your managed portfolio, right? They're not going to give it to you. So let's go back to this example. We're going to turn your income on in year 3 there, right there. It's going to be $56,000 a year. Go across to the left under contract anniversary value. See, it says $589,675 because for the previous 3 years, Merrill Lynch and DFA had negative rates of return, and you didn't make any money, and you paid a fee. Your account went down, right? Like we did with anything else. Now, all of a sudden, $56,193 is also coming out of your account value, and see it's going down from $589 to $525 to $460 to $395. Because not only are you paying a fee of 1.1% a year, but you're also taking out $56,000 of income out of your portfolio. If that happened when you were 73, and DFA and Merrill Lynch, if we never changed the indexing strategy, never made a penny, you're out of money. Your 613 is gone. Now let's go across the line here, all the way to the right. You would have taken out $561,000 on the right-hand side, where my mouse is there, in cash flow. You put in 613. The difference between those 2 points is the fee you paid, because you made no money. But guess what? All of a sudden, see that 56,193 in green? It never stops. You lived to 90, 95, 100, 105, they're obligated to pay you. So in this example, this is the worst case scenario, right? You gave them, the insurance carrier, $613,000. You paid a fee of 1.1% for all the guarantees. You never made any money because those indexes did lousy, the market was terrible. You had no risk. You started income for my plan, and your income was guaranteed for life. They basically gave all your money back, less the fee. They would have given you all the gain, right? And they kept on paying you. Pretty good deal. Bad deal for the insurance carrier if that happens. Because at 73, you live to 93, for 20 years, they're going to have to pay you over $1.2 million. It's a bad deal for them. They want you making money in those indexes, but I'm giving you the worst case scenario. And the far right-hand side over here, you can actually see if you lived till 90, far right, they would have paid you $1.573 million in cash flow for your 613 investment, and you never took a risk at all. And by the way, if you run out of money, you got no fee because they can't charge you a fee when you have no money. Does that make sense? Now, I don't know if y'all do this or not. I hope you do, but I try to be real thorough on this page so they get it, right? Now, they've already seen the annuity PowerPoint that I did for them at meeting number 2. They got the concept. Now I'm just digging deeper into them. So I said, now, Mr. and Mrs. Smith, this is the worst case scenario. Now let me go you to the best case scenario. The best case scenario, these indexes do okay. Same strategy, but what it's showing you here is the hypothetical values, hypothetically, what Merrill Lynch and DFA did in columns 3 and 4. It shows you the hypothetical rate of return. Credited interest rate after 2 years, you see where it says 33.7%. That just means they added up years 1 and 2 with Merrill Lynch and DFA. They applied that formula, right? Merrill Lynch is going to give you 100% less 4.2 for 2 years. DFA is going to give you 145% minus a percent, and you would have made 33.7% or $204,000. That $204,000 went right back into your account value. So again, 613 went in, it dropped to 606 at the end of year 1 because you paid a fee and no gain. But then it went up to 801,000 because you made 204,000. You still paid the fee, but now you net, you're up to 801. So you can kind of see what happens here. Now, on the right-hand side, the dark blue ribbon, they started you off at $64,000 in this example versus starting you off at $56,000. Now, in your plan, I'm only using the worst case scenario, $56,000. I'm not using the $64,000 because I don't know if that's what's going to happen. So what happens is AIG has a calculation, it's a formula. And it's a little complicated, but they take your basis minus your fee plus your gain. If it exceeds a certain trigger, they're going to give you an income increase. In this example, you would have got an income increase. So your income would have started off at $64,178. But I don't want you to get that in your mind that it's going to happen. Just I want you to forget about that for a minute. I want you to think the worst case scenario, which I showed you on the previous game, $56,000. But even this example, let's assume you can see here in the 6th column interest earned. If I go to the next page, you add all that up, you would have made $844,000 of interest earned in this example, right? And even so, when you were 83, you still ran out of money. And you say, well, how's that possible? Well, they started with 613. You made $884,000 of gain. They went right back to you. But you started taking $64,178 of income off your portfolio. And eventually, because you're taking that out consistently, like any portfolio, you would have run out of money at 83. But let's say you live till 93. 10 more years, they're paying you $64,178. That makes sense? Yes. I said, okay, now let me compare this to assets under management. Let's just take the best case scenario here. Let's assume that this was not an annuity, but I was managing your money, or you're managing your money with Vanguard or whomever you're with. And let's assume we did the same thing. You started with 613. You had all these gains of $884,000, and you decided to take $64,000 of income. And if I divide 64,000 into 613, that's about a 9% distribution rate, which you can't take out of a managed portfolio, but unless you did, say you did. You still would have run out of money at 83. And you would have been out of money and out of income. And you still would have paid the fee. But unlike this, you would have had losses. You probably would have ran out of money much sooner because you would have had losses, which you don't have in the annuity. So the annuity is here to give you, Mr. and Mrs. Smith, full protection with your assets, no market risk, no interest rate risk, a distribution rate of, in this example, divide 64,000 to 613,000 of 9.5%, guaranteed for life. And if you do run out of money, they'll continue to pay you. Does that make sense? Now, when I go back here, this is how I want you to make your decision today. As I finish up your income plan, I want you to tell me, are you comfortable with giving AIG $613,000? They're an A-rated company in business over 100 years. No one's ever lost money in history. and a fixed annuity with any carrier. They're going to insulate you from any market risk. They're going to insulate you from any interest rate risk. They're going to give you a pension-like income stream in year 3 of $56,193 at the minimum. And if you're renting money, they'll keep on paying you. Would you be interested? Did that resonate with you? And what do you think they say? Absolutely. 100% of my clients say, yes. Nobody ever tells me I don't want to do an annuity. Never. The only time they say you don't want to do annuity is on the first meeting, if you got a stock jockey, a day trader, and I know that he's fine with risk, I don't do the annuity. But that's 1 in 100. I don't want that client. He's not my client, right? But Dan and I don't skip a step. We're going through this methodically, right? This is meeting number 3. They've already seen the annuity presentation. We talked about the annuity in the very first dinner presentation. They've been acclimated to this level of knowledge and the skill set, and they will never will they tell me, Jim, I don't like that. They'd be stupid, right? I say that so nicely, but they would be stupid because I still have money, assets under management. Now, if they say, well, is that a lot? I said, well, what I did for you in your income plan is I got you enough income between your Social Security and the annuity to cover your cash flow needs for the next 30 years, including inflation, and a little extra there for travel money. Now, if you don't want that amount of guaranteed income, I'll strip it out. Tell me what you want out. I can do whatever you want. Oh, no, I like that, Jim. I like exactly what you've done there. So the annuity presentation is going to take you 15 to 20 minutes to do, like I just did. So I'm getting back to meeting number 3, and meeting number 4. 10 minutes on the front end, welcoming the client, tell a little bit of story. And then the rest of it is going through the income plan, tax plan, LACI plan, and explaining the annuity. It's a full 2 hours. You're going to butt right up to that 2-hour mark. Meeting number 4 is identical. No difference except the book is in front of them. It's going to go the full 2 hours. Now, on meeting number 4, we have the binder in front of them, right? They're going to see the binder with all the tabs. They're going to take that binder home with them on meeting number 4. And at meeting number 4, this is how I do it. Dan always brings people back at meeting number 5, which is fantastic. That's just his style. But I give a client an opportunity at meeting number 4 to make a decision. So at end of meeting number 4, I've been with them for now 8 hours, right? 4 meetings. They know me, I know them. We have a great rapport, great relationship. They trust me. When I get into meeting number 4, I hand them the binder. I said, I take the table of contents. I circle the things I want them to go home and talk to each other about. I said, when you take this binder home, I want you to take it home. These are the things I really want you to discuss between you, Mr. and Mrs. Smith. And when you come back on meeting number 5, I'm going to ask you some questions. I'm going to give you a little test. I want to make sure that you guys fully understand your plan and you're totally comfortable with what I put together for you, because I can change anything you want at this point or in the future. I said, oh, no. They say, well, I said, what do you think so far? Oh, we love this. This is fantastic, blah, blah, blah. I said, okay, this is the last 5 minutes. I said, we got 3 choices. Choice number 1 is you take the binder home and you never come back. And you can do that. I will never call you again. There's no pressure at all. My office won't call you. We'll take you off our list of contacts. And you got a free plan on it. You got 8 hours of my time. You got another 30 hours or 40 hours of staff time, and you get a free plan. That's one option you have. Option number 2, you take the plan home. I want you to take little Post-its, and I want you to put on any page that you don't understand. I want you to put a little note there, so when you come back at meeting number 5, I'll answer all those questions for you, and we'll go through everything. And then if you decide that you want to proceed, that's meeting number 6. We have to schedule a whole new meeting for all the paperwork. We can do that. Or your third option is, and yesterday I had 2 clients, morning and the afternoon. I did the same scenario. Your third option is that you guys say to yourself, I'm comfortable with the plan. You think you want to proceed forward. You don't want to spend 2 more trips to do the paperwork. You still take the plan home with you. You still put the Post-its on it. But if you want to proceed, at least I'll have the paperwork ready for you next time, so that when you come in next time, we'll spend the first hour going through any questions you have. And then if you still want to proceed, the paperwork will be done. I'll lead you over to the prosecuting part. We'll do all the paperwork. It just saved you a trip back and forth. But any one of those three works with me. It's up to you guys. And yesterday I did it twice. Well, no, we want to proceed. We want the paperwork to be done next time for you. So often I'll skip that one meeting, but I give them a choice. I give them a choice. We don't have to do. We can come back and meeting number 5, come back with meeting number 6. I don't care how long they come back, but it's a real simple close, and they always pick the last one in 90% of the cases. But if you're not comfortable though, and if you aren't comfortable, that client's tracking with you, then I don't offer that third paperwork decision. I only give them, take it home, come back to meeting number 5. So you have to be comfortable as an advisor knowing that they're tracking, they get it, they've asked all the right questions, the body language is there, so that you can actually ask them to come back at meeting number 5 and do both a wrap-up and paperwork.
Jim, I think that's great. There were a couple of questions. Okay, Ben wanted to know, in the hypothetical numbers, are you using the best 10 years?
Well, this one here, it just, all these illustrations are different. They're all different. So you can use whatever you want. You look here, the best 10 years, Allianz does. AIG doesn't do the best 10 years. They're just giving you the data for how many years there? 30 years. They're giving you 30 years worth of data right there, right? So whatever you're in front of, you can do the best 10 years, the best 20 years, doesn't really matter. The whole concept is not to get the client to think they're going to get those rates of return. That's the worst thing you can do. That's the worst, because they're not going to get those returns. They're not going to. Get the client to understand the concept, and the client needs to be sold on that right there. If they never make any money, I will not proceed forward with the client with them thinking they're going to make a bunch of money. If they do, great, but that's not what the annuity is there for. It's for protection and income for life. So show them this, but I said discount this. I said I don't want you to think you're going to get those rates of return, because first of all, they're hypothetical, and it was a bull market for 13 years. But I said, yes, you can get rates of return. I don't know what they're going to be. What I want you to make a decision on is this page here. What if you never get a rate of return, or the returns are paltry and you run out of money? Are you comfortable getting income for the rest of your life if that happens? That's what I want you to make your decision on. And if you do it that way, you'll have a great client for the rest of your life. You will. They will never complain about them only making 1% or 2% or 3%. They won't complain about it.
No, you're right. Nasir, did you have something you wanted to ask?
Yeah, that 613,357 is an odd number. How did we come to that?
Which one now?
The 613,000.
Oh, because it was the amount of money in her 401k exactly.
Okay.
So I just took the exact number and stuck it in there. In the end, it could be 630 or 620, but I just pulled it right out so she could mentally say, oh, I have 613 in my 401k. You're just moving that over to the annuity.
Okay, thank you.
Mark also said another benefit. This must be just when you were talking about benefits of annuities. It has the death benefit too, same as the income-based account value.
Yeah, the death benefit is going to equal your account value, right?
Yeah.
And that's what's going to go to the beneficiaries. I explained that also. Good point. I didn't explain that just now, but I always explain it to the client. When you pass away, if you passed away at year 7, there's $331,000 left in that account value that goes to the beneficiaries. It's equal to your death benefit on the right-hand side. But in fact, the death benefit on the AIG is a little bit, if you don't make any money, the death benefit actually is higher than your account value. They give you a little bump.
Yep. And then Gilbert wanted to know, what are the things you circle on the table of contents for them to look over?
I circle how I laid out their money. I have a spreadsheet there, so they understand how I move the money from A to B. I circled the income plan, the tax plan, the legacy plan, the fee plan. That's it. I want them to be focused on those 4 or 5 spreadsheets, because in the binder we have all kinds of data. We have the brochures, we have our ADV, we have our money manager stuff. I don't want to get haywire, too much data. I focus them on the things I want them to be understanding: the income plan, tax plan, and legacy plan, fee plan, and how I reposition their assets.
Yeah. Kurt, you were asking if there are notes in the PowerPoint, the generic annuity PowerPoint presentation. There are not. notes. Most of that is just kind of read from the slides that are on there, but there is a video of, I believe it's Dan giving that annuity presentation. It's in the coaching tab of the website. So if you want to see how Dan goes through that, what he says during that, that's on the coaching tab.
That's the PowerPoint, not the illustration, though.
Right. Yes. Yeah. He was asking for the PowerPoint.
The illustration, I know you all have your own style, which is great. And I hope I was clear the way I explained it to everybody, because remember, the client has no idea how this stuff works. So we got to be really, really clear. I go from, I kind of, light ribbon, dark ribbon. I'm walking them through column by column, taking my time, because I want them to understand this. I want them to understand it. And then when I do the illustration, and when I'm done here, I said, by the way, I'm going to give you guys a test now. And they go, oh, what are you going to ask me? They're like, oh. I said, okay. When you put your money into this contract, if the market goes down anytime in the future, how much money can you lose? They look at each other. None. I said, great. I said, once you start income, if you run out of money, does your income stop? No, it continues for life. Great. I said, with this, since we're deferring for 3 years in your plan, will the income stay the same, or does it have the possibility to go up every year at a certain rate for as long as you defer? Oh, it goes up that 8 or 8.5%. Great. You passed the test. Oh, and I say, by the way, I said, if you both passed away at any time, and there's money left in your contract, does the insurance company keep all your money? No, it goes to my kids. Great. Real simple, right? They take ownership of it. And if they can't answer those questions, I explained it wrong and I start all over again. Got to be clear. It's got to be clear to them, and they got to understand it. They're investing lots of money in this stuff, right?
Definitely. I think, oh my gosh, it's a minute after we got through all the questions that I can see. I think that was great. I loved going through that line by line. Obviously, it's hugely important to make sure that you're covering all that. But I like that you do the little quiz that keeps them on their toes. But it's good, for them to think about those things and to be able to.
It engages them, and that's a killer. Yeah. You're engaging the client. I engage them with lots of different things throughout the process, but that's just one on the illustration.
Yeah, that's fantastic. Well, thank you so much, everyone. Thanks, Jim. I hope you have a great time in your vacation in Lake Tahoe at your vacation home. And I hope everyone else has a great weekend. And I will see you all next week. Take care.
Thank you, Jim. Thank you, Dina.
Yeah, thank you.
Good.
Thank you, Jim.
Recording in progress.